Hey everyone, welcome back to another episode of The Meet Kevin Show. Today we are talking AMC, the short squeeze of AMC, and what's next. What's next is always very interesting, and to help me figure out exactly what's next and what the future beholds for us, I brought Matt and Trey. Welcome aboard, everyone. Super excited to have you here. Thank you so very much for being here. Welcome, and introduce yourselves, shout out your channels, and let's get into AMC.
All right, Trey, lead us off the bat.
Go ahead, Trey. Trey, I think we've got a
well, Kevin, it's great to be here back for the second time. It's been a while. Obviously, love watching your stuff, and obviously, Matt, we're pretty familiar with each other.
Yeah, what's going on?
So who I am, what Matt's been doing. I've just been covering AMC stock. We've been freaking just. Everything okay on your end? Is this all good?
Yeah, we'll lose a tiny little bit here.
We've just been covering AMC stock and talking about, all this stuff that's perfect. We've just been talking about, the short interest, the squeeze potential, the failure to deliver, a lot of the malpractice and corruption that's circulating around Wall Street, and a lot of these big boys who've been betting against AMC stock, and me along with Matt have just, kind of gravitated towards this awesome culture. Who we call the apes, and we've been trying to tell the story of the little guy, the 99% fighting the 1%. They try and say it's not what it is, but that is 150% what it is. And it's a proud title that we wear. And it's been a fun piece of culture to be able to talk about.
Yeah, I'm definitely right on board with that. Just to reiterate it, I know we're having a little bit of tech issues. My name's Matt. Right here we have Trey. We're just big supporters of what's going on in this social cultural movement with AMC. And that's what we're kind of here today to do, is just to explain the story from a high level. Then we'll get down into some of the weeds of just what's been going on and why this particular storyline is just resonating with so many different people.
Absolutely. Now, I want to know from both of you, from somebody who is just getting started, just hearing about AMC, they hear the, really craziness, because it is, of AMC going up 100% in a day, preceded by multiple 20% runs. The stock is up 2,900% for the year. How does somebody dissect what's happening here? Because, most people who are looking at investing aren't super familiar with short squeezing. They're not super familiar with hedgies or gamma squeezes and all of these. How do you explain this to somebody in a 1-minute version? I'm going to start with you, Matt, and then go ahead, Trey, after Matt there.
Yeah, definitely. So just what's going on right now is there's an interesting scenario specific to AMC stock where there's a bunch of hedge funds who are trapped. So for those of you out there, when you normally buy a stock, let's say stock XYZ, you buy it at $10, you hope it goes up, let's say to 16, and you profit $6. On the flip side, there is a mechanism in the stock market where you can actually bet against the stock and you hope it goes down. Same example, you get into XYZ at $10, you hope it drops to $7. And then at that scenario, you would profit the $3 because of the drop. So usually you buy and then you sell. Shorting is the exact opposite. You end up creating the position by selling, and then you buy it back to close the position. So why this is interesting is, usually when you buy a stock, you want it to go up. And if it starts to drop on you, that's where you hit your pain threshold, for lack of a better terminology. Well, shorting, when it starts to go up on you, that's when these shorts really hit their pain threshold. And what's going on right now are there's so many different hedge funds and different players betting against AMC. As it goes up, they're feeling the pain a little bit more, and it's starting to build. And that's why you see these high velocity moves, because there's so many people betting against it that it's kind of like a weird game of hot potato. If you don't want to be the first one out, but if you are, and then that can kind of lead almost a panic of people betting against it. And that's where you see those massive velocity moves upwards. So what this is right now, it's where usually when there's big money betting against the stock, you do see it kind of come down. But right now, there's such a rise in retail traders that as it starts to go up, you're trapping more and more hedge funds. And then you have more and more retail traders piling in. So it's almost a big game that's, I guess, as I referred to it earlier, playing out on the stock market of a bunch of retail versus a bunch of hedge funds on Wall Street.
Wow. Let's hear you, Trey.
Yeah, so to basically just take what Matt said and add a small piece to this, the short interest, or the idea that people are betting against AMC stock, kind of got coupled up with what I would call the foundation of this entire new breed in the stock market, which is the apes, right? So you have Wall Street Bets. Wall Street Bets and DFV, or Roaring Kitty, they essentially started GameStop, that wave, this retail trading frenzy where people got the idea of, hey, through a lot of people together doing due diligence, crunching research, we can essentially find companies that are worth more than they're currently trading, who are being bet against very heavily by big money, these big hedge funds, institutions, the hedgies, trying to steal our lemon pepper tendies, you know how it is, and essentially come together as individual people and say, hey, I like this stock, I'm going to buy this. And that's the emotional, cultural aspect of this, is the unquantifiable, or you can't tangify this idea of how much it's brought people together.
Yeah. Now, I want to ask both of you there, how
all over financial media is they're viewing this as a black and white. There's heads and there's tails. This is just an overvalued stock. But nobody's going to, come in here and say that they're investing in this for fundamental reasons like these hedge funds are.
I want to ask both of you, how do you compare AMC to GameStop when GameStop was over 130 to 150% short at one point? And AMC here at the peak in the last few weeks has been, at least from what we could see publicly, 19, 18 to maybe 21, 22% short. Is there more that we don't see here? Maybe is this where these phrases of synthetic shorting and naked shorting come in? And why would AMC have these styles of shorting when with GameStop it was much more transparent? And so, Matt, I think Trey's going to rejoin here. So maybe we'll start with you and what do you think about that? I certainly know the movement stands behind AMC now, like it stood behind GameStop. But why is the shorting and the shorting statistics, why are they so different?
Yeah, so I could take that and let's split that up into two different parts. So part one of just the numbers we know that are like, there's the data sources out there that we can verify it. So yes, back in late January, GME, GameStop, peaked at a short interest of 140%, which is astronomically high. So with that, I don't know. I guess you could compare this as a little bit more of like apples and oranges, because GameStop and AMC, not every stock out there has the same amount of shares in existence. That's referred to as their float. So right there, GME, AMC, two different floats, two different short interests. And I think we could use it of more of the emotional and social aspect, like to overlap those two. But even with AMC right now, we're bouncing somewhere between, let's just call it 18%. I get it. It's a lot lower than GME. But one thing that you have to count with AMC right now, between Facebook groups, Reddit groups, YouTube communities, and then also Twitter, there's such a community surrounding it. While when GameStop was going, it was a large community and they were very, very passionate, but it was mainly in Reddit. And what's happened from late January until now, when we first started adhering to GameStop, and now why we're here currently talking about AMC, is day over day, the AMC community is just getting absolutely massive. So when you're getting into the exact numbers of like, okay, how do you account for that? Like, is there enough passion within the community that it basically makes up for like that drop in the short interest? That's like one interesting way, I guess you could consider it. But then the other part of it, or hang on, let me retract here, is even with the short interest around 18%, I know it's smaller than 140 if we're going to compare it to GME, but I know you're a big supporter of Tesla right now, and that's actually considered to be highly shorted, and that's around 5.8%. So even in pure magnitude, it's still like a highly, highly shorted stock. And we see that just in the cost to borrow, the supply and demand of like, oh, I want to short AMC. The cost to borrow is abnormally high. There's still a lot of demand and a low supply to actually short AMC. And then to get into that world of where the things we can't specifically talk about, or like, I guess, point out the data to prove what we're saying, is more of this world of naked shorting and synthetic shorting. So just do you want me to dive into that of like the mechanics?
Well, I want to hear, and then I want to ask Trey as well, and maybe we'll hit those mechanics. But I want to ask, you mentioned cost to borrow. So how do you compare this? Because generally, when I think of cost to borrow, I think the riskier it is to lend, the higher the interest rate to compensate for that. So are you looking at not just short interest, but comparing this cost to borrow, and what are the differences that you're seeing between, let's say, I don't know, Apple, which I imagine would be very inexpensive compared to maybe Tesla and AMC?
Yeah, so cost to borrow, I like to think about it. So in general, for the audience out there, to take a short position, you actually have to borrow it from someone who originally owns it, and you pay a borrow fee. And if you look up the percentages, that's if you were to like hold it for a full year, but they pay a fee per day. And I think of it as the most basic terms of supply and demand. How hard is it to locate these shares to go on loan, and how many people are wanting to actually short it? So I think 2 or 3 weeks ago, AMC's cost to borrow at one point was above 150%, which is absolutely massive. And if I'm right, the last time I checked Apple this past week, its cost to borrow was 0.8%. So that's like the stark difference. Like very, very easy. It's just shorting in terms of the market. People have this assumption that like half of the people go long, the other half go short. Shorting is actually more of a rare practice. I think about 5% of traders like actually engage in shorting stocks. It's very much a long only based stock market system we currently have going.
Trey, what do you think about all this and calculating the difference between margin or rather shorts outstanding and GME and AMC and why this movement is doing so well despite those differences?
Yeah, absolutely. So I think the cost to borrow, and what's really indicative of this entire situation and how incredible the short interest is if you look back to January, you have not been able to short AMC stock in a plethora of different brokerages since January, which calls it one thing, a hard to borrow stock. Now, I kind of hopped back in at the time. I think Matt was talking about, the actual share availability and the fact that there's some pressure here, but that cost to borrow goes up, basically in respect to a couple of things. How hard is this to borrow in terms of the security itself? How many shares are available to borrow this? And then what are the odds of you coming out profitable? So if there's a crap ton of momentum on a stock like you've got on AMC, I mean, the chances of you getting squozed out of your position or essentially, crushed down, it's pretty high. So it is true that GameStop had a higher overall short interest, but what Matt was saying is absolutely true. To have 20% short interest on a stock is absurd. I mean, when you think about the total shares that exist in the market right now, like I think it's about 500 million to share of that after all of these different offerings that have happened. The fact that 150 million, 155 at its peak were on loan, and then about 100 million of those were shorted into the market is absurd. I mean, that's a lot of short interest, and the amount of people that want the stock. That's what it comes down to, essentially. So while the numbers are different, those are the quantifiable things that we can prove. But then you got the unquantifiables, right? So failure to delivers that derive from essentially the call options that were previously out the money, meaning they're above the current market value, that run in the money, and market makers have to hedge for these. If they can't hedge for the stock or they don't have the stock to deliver, they send out IOUs. And this essentially, acts as synthetic selling pressure, an unquantifiable thing in terms of short interest that adds to the potential ceiling of AMC stock. And then you've also got the naked shorts, which CNBC obviously leaked out to the internet for everybody to see. That was no new news to the apes. We've all known that for a long time. But there's a lot of other things other than just what's reported. The 85% exchange data that's given to Ortex, reported being in quotations because we know there's a lot of FINRA reports coming out, stating that there is malreporting. There's so many things going on here beyond just the actual short interest that we see at the naked eye view.
Yeah, so I want to ask you about that and sort of dissect this. We saw this with CNBC, and I want y'all to clarify it better and explain it better here. I want to know, why is it such a big deal if there is naked shorting happening? Isn't that normal? Isn't that something that happens anyway?
Here, I could take this one, Trey.
Yeah,
no, it shouldn't happen. It's funny. When that started, it was trending on Twitter yesterday, and it said now illegal practice, naked shorting. No, it's been illegal. Like, we've all known it's illegal. It's very much an illegal practice. So it's weird that like that connotation with it. But what it is when you short, you borrow it from someone, you short it, you buy it back, and you give it to the original owner. When you're naked shorting, you never did that first thing. You never borrowed it. You literally just sold it to the market, something you never had. And right there, you're creating it. And that's when you hear the terminology of a synthetic share, a phantom share, whatever you want to call it. It is a share that should not exist. It kind of just came out of the ether, and now it exists. And why that's so bad is classic supply and demand. You increase supply, and at that moment in time, the demand stayed the same. You're driving the price down. And like with this, like there it could be a multi-hour discussion and like how that could even get worse. Cause like now I think I own it, and then I loan mine out to another short because I don't plan on getting out anytime. So you have it's almost the tree root system, is you start with one thing and you don't know how bad it gets. And with that, people argue is like, okay, maybe a broker lent out shares they shouldn't have. It's their job to buy it back. That's what Trey was referring to with the failure to deliver. And that's cool. But also, you don't know how much damage was done before they bought the first shares off the market. It can just get so out of hand so rapidly. And what you're doing is increasing supply, and you end up driving the price down. Right now, it's illegal. And that's the big question of like, okay, how many of these illegal synthetic shares are actually out in the world, not just for AMC, but in the market in general?
Trey, what do you think?
So what's interesting about naked short selling is while it does increase that supply and the demand stays the same, it gets even worse. So think about this. If I had one banana and I wanted to sell one banana, I'd just sell one banana, simple as it gets, right? Because that's all that I have. Now imagine you've got competition who wants to squash your business and what you're doing basically legally, right? So they decide I have one item and I decide instead to sell 5 bananas. 4 of these don't exist and one of them does. And I've got no way of proving to you. Essentially, let's just pretend this happens over the internet, same as these transactions that happen electronically. And their goal essentially is to drown out the fair competition, the people who are playing it by the books. That's what gets really fascinating about this is the short sellers out there are betting against AMC stock. I mean, why do you think you see the financial media out here putting out pieces about, how this is dumb money and you're going to lose your money. You shouldn't be here. This is gambling. They've got no reason to protect your cash. It's for them to protect their cash, right? Because they're protecting suits. That's what financial media does. It's there to protect the suits essentially. So what the unquantifiable piece, I keep coming back to this because Matt's the data guy. I'm kind of like the hype man that likes to throw both things into it. The unquantifiable piece is how malicious some of this stuff really is. I mean, it's unquantifiable and hard to really paint the true picture on how deep this runs. I mean, AMC, I truly believe, if it wasn't for the apes, would have gone bankrupt. In January, there was a really strong thesis for a short case. I mean, they had a pretty decent cause in saying this is a shortable stock. But with each passing month, as this continues to go on and on and on, the short thesis weakens. The amount of apes out there who are fighting with AMC stock grow stronger. You grow farther in number. There's more money getting put into the stock itself. And it's just being exposed. I mean, like we already mentioned, CNBC coming out and talking about naked short selling, the illegal practice of selling things you don't own. It's malicious. That's what it comes down to. It's
now in that
mind-blowing.
CNBC
I don't
video,
there's no other way to put it.
That in that CNBC video, they removed that later, but obviously it was recorded live by many, and once it's on the internet, like you say, it stays on the internet. Why do you think they would remove that? Why is it not okay to talk about on financial media?
I kind of view it akin to they just know they're throwing gasoline on the fire. If you look at how certain things played out in late January with GameStop, it's just any recognition of it kind of like got more people involved. Like think about how many people over this weekend, because of that clip alone, had no idea what was going on with AMC and they're playing into it. It's one of these psychological wildfires. So things like that, I honestly think them even taking it off, that builds up the mystery, the intrigue. They're literally dousing this entire situation with gasoline.
Got it. What do you think about that, Trey? Why would they remove this?
I think it's them essentially realizing that they got caught pissing on the electric fence. This is the problem, right? Is if we, me and Matt decide to go on national news and make a claim stating, hey, there are naked shorts on the market, and we can't quantifiably say who it is, how many there are, there's legality issues there, right? So for them to come out and say that, I think they realized they unboxed Pandora's box, man. I mean, there was trending on Twitter. Naked shorts was trending on Twitter. It's all people are talking about. And then that third piece, the unquantifiable, is the hype. I think going into Monday, there's going to be a lot of people excited who probably never seen AMC stock before until that got leaked, who are going to be like, all right, it's freaking game day. Let's see what actually happens here.
Wow. Now, historically, when have we seen this naked shorting have a massive impact before, or is this something that's unique? I mean, and is it solely because it's so expensive to borrow the shares, or really 3 questions here. Has this happened before, the naked shorting? The next question would be, how do you do it, and why not just borrow it? Is it just because the costs are too high?
Matt, do you mind if I speak on this? I've actually got some really good DD that I did. I'll let you go next if that's cool.
Yeah, go for it.
Yeah, so there was something really interesting that happened with quarantine and COVID, right? It was called the supplemental leveraging ratio. Now, this was the idea that big banks who were really suffering for a long time because of essentially people not being able to pay on their mortgages, and they were losing out on a lot of capital, right? Were able to lend out more liquidity to big hedge funds, right? So what happens now is you've got over leveraging from a lot of different, hedge funds and institutions out here in the market. And what they decided to do with that capital is bet that the economy would continue to suffer. They tried to target companies that they thought would not survive quarantine and COVID, such as AMC and GameStop, and they over leveraged themselves in it. Now, if you're over leveraged in a position and it's hard to borrow stock, how do you create that naked short, right? Well, if you can't borrow the stock, you have to find some way to short it if that's what your end goal is. And that's what they do, right? So for hard to borrow securities like GameStop, which was the original, Wall Street bets, the Reddit frenzy, the foundation to where we are right now, they couldn't borrow any stock, so they naked shorted it. And that's essentially what the whole origin of this is to me. And maybe some of this is speculation, but these are things that have happened, right? Supplemental leveraging ratio did happen, and it created this huge amounts of liquidity that got pumped out in the market. Short, I mean, you look at the last 9 months or so, the amount of shorting that's taken place is historic in terms of what you've actually seen in years past. So it's very unusual because AMC is just one of them. I mean, you look at Microvision, Express, Koss, Bed Bath & Beyond, GameStop still to this day. I think Root is one that people are starting to talk about. It's everywhere. Everywhere you've got insane shorting, and we can only assume along with that naked shorting with hard to borrow securities that is taking place.
So the SLR you touched on, the supplemental leverage ratio, this was you think this was a way that sort of spawned this naked shorting? I mean, maybe can you clarify on that a little bit more, because this was something that was imputed by the Federal Reserve and to make sure that banks had enough liquidity. Do you think that basically just removed money from the market and therefore led to this naked shorting, or maybe I missed the connection there a little bit?
Yeah, so this SLR, the supplemental leveraging ratio, essentially, it allowed these big banks who were suffering massive losses in liquidity, right, to make back amounts of money by lending out, capital from first the Federal Reserve out to banks, and then banks out to hedge funds who decide to borrow liquidity from these big banks. And you've got this huge amount of liquidity that should not be in the market because it's essentially borrowing coming from borrowing that went into the stock market to short different securities.
I see. Okay. Yeah, because that's something that's pretty common that happens, especially among institutions. And it's really a lot of what happened in 2008 on sort of broad scale as well. As it's really betting on top of betting, right? I mean, it's making a bet, let's say, against mortgage-backed securities, and then getting a credit default swap on top of that, and collateralized debt obligations, and all these incredibly complicated financial instruments. And so what you're saying is, really, maybe it doesn't even matter what we call it. We just know that enough of the institutions are making enough bets with whatever crazy instruments they have against this. And the more the price goes up, the more all those contracts they have fall apart. And that's the bottom line.
Absolutely. So think about this. If there's a short position out there and you've got infinite downside for loss, or you can lose an infinite amount of money, they establish their short positions because the short interest has been anywhere between 15 and 20%, sometimes even higher than that for months now. Literally since, I would argue, probably March. What do you think, Matt, about March? About that time frame? So since March, back then, the stock was trading between $9 and $15. We'll give them the benefit of the doubt, right? We'll say they're $15 cost average for the majority of these short positions. Maybe some have covered, maybe some have established new positions. If you had an average cost of $15 in your short position and you're trading at 47 right now, you're down a substantial amount of money. And where does that come from? How are they going to pay that back? I mean, the leveraging here is what's incredibly scary about AMC stock and how bad this could get for the hedge funds, and why some people are so bullish on AMC is because you can't quantify how much money is going to have to go into this stock to get everybody out of their essentially negative short position.
Yeah, that's incredible. And now, is this something that is going to be ubiquitous? Are we going to see this just regularly happen to different companies? And really, what is the next step? I mean, so AMC's got a bunch of contracts of people betting against it. It's hard to quantify. In theory, they could continue to throw money on their contracts in perpetuity as long as they have more money. And it becomes this tug of war of who can last longer, right? But at some point, it's not going to be AMC anymore. So how does that transition work? Like, where do people go from here? Is the rocket ship still coming? And then when does everybody kind of get off? And then does it all go into another stock, or do we get a little bit of what we had after GameStop, where you had this like shotgun effect, where it was like 5 different stocks picked up momentum, right? And it was hard to get that concentration again until obviously now with AMC. So where do we go?
I could take that one. I mean, for me, and I think we're all in it for different reasons. For me, I will get out when the shorts cover. And that's a tough one because it's like, okay, we can only see certain amounts of data. So like, okay, I could see that all the legitimate legal shorts covered. And it's like, well, at that point, it's a little bit of guesswork because the entire report of naked shorts is that they're not reported. You don't have the data. So with that, I'm looking for like the legitimate shorts, and I'm assuming a same proportion amount of illegitimate shorts will also covered. So that's for me. I'm not picking a date. I'm not picking a price level. I get out of the play when the shorts actually cover. And I don't want to rewind too much, but I think there's going to be some of the questions about naked shorting. So for us, if we're on a brokerage such as Robinhood or Webull, it's not like hedge funds open up their equivalent, which is referred to as prime brokerages. It's not like they have a special naked short button. It's not like now they're like, oh, we're going to like do this now. And this is kind of an important thing to distinguish is, so we have brokerages, they have prime brokers. And this is cool because the news just got reported with Jefferies and I believe Raymond James that they've stopped it. So they would call up their equivalent like, hey, I want to short 1 million AMC. What's weird is this could be one particular scenario of like, hey, they're trying to get that business. They're trying to impress the hedge fund. They're trying to keep that as a client. They're like, hey, we'll do it. It's actually on the brokerage to locate the shares for them to short. So they're like, yes, here's the go ahead, go do it. And then they have, because of the T2 settlement, they have 2 days to actually locate those shares after the short was already taken. And they can actually, there is a mechanism where they can kick that can down the road even longer. And that's what Trey was alluding to with the failure to deliver is like, they did not deliver on those shares, even though so many things could have happened in that meantime. So right there, it's like, we're talking about hedge funds, but this is like one of the things, one type of failure to deliver, in this case, naked shorting. It's like they thought potentially they could have had a legitimate short. The shares were never found. And then it becomes an illegitimate short because they never located them. And that's just one type. And the way our reporting system works now, it's about a 2 month or a 2 week to a full month lag. And then we could see those. So like we're kind of always dealing with old data. And on certain days, there could be 2 million failure to delivers related to AMC alone. It's like, well, what's going on with that? Does it relate to the options market? Is it a naked short? This entire thing is now that more people have become very interested in the stock market, we want the transparency. The fact that there's hundreds of thousands of people putting in a little bit of work every day, just barely scraping the surface of what's going on, tells you like, okay, that tells you the complexity and the confusion in the stock market. And as a retail investor, trader, we just want answers. The fact that we have to come on and have discussions like this just to make a little bit of headway to find out what's going on tells you about like something in the system can't be working properly then. But overall, I just wanted to clarify that about naked shorts. It's like, it's the association with the broker. They never, ever located it. And then you end up selling things that don't exist. But moving forward, I don't know. I honestly think that Wall Street has permanently changed. For me, I'm waiting for this particular storyline of AMC to play out. I'm waiting for the shorts to cover and then on to the next thing. But who knows? Are they going to learn their lesson, or is there going to be a whole nother stock? And then we're just going to round 3, GameStop, AMC. And then maybe there's like just wild card XYZ. You never know where this could go.
Right. Now, this is interesting. So essentially, somebody says, hey, we want to short X million shares. You guys figure out the details. This makes sense because it's all about providing customer service for the big boys, the big brokerages, playing customer service for the hedgies. This makes sense. So, okay, well, why is these failure to delivers a bad thing? I mean, don't they eventually get located? You mentioned maybe 2 million on a day. We're talking about like 0.4% of the float, or maybe even lower. Does it really matter?
I would say it matters because it comes back to the fact that, all right, the 2 million shares, let's say I never located them and you shorted them in this example, someone else bought the 2 million. Well, that 2 million, as now that there's a new owner, they could loan it out and increase the short interest even more. Like you just never know the spider web of that original first share and how bad it's going to get. So even if the brokerages do what they're supposed to, be like, okay, we messed that up, let's buy them off the market, the damage is done because you don't know how far out of hand it got from that moment, because it takes multiple days for all of this to get like cleared by the DTC and whatnot. So you just don't know the spider web. Like it's almost mathematically impossible to track really what's going on once the first illegal illicit share like enters the market.
Yeah. Now, Trey, I want to ask you, do you think it's possible that maybe the DTCC or whatever sees this nonsense happening and says, you know what, we got to shut this down. We got to stop this from happening. Is it possible that we see another Robinhood essentially, where it's, hey, you know, we just need to have people stop buying so that way we can clear up all of the disaster that's happened in the back end?
You know, I like to think that January, you would have some people who learned some lessons about collateral and liquidity and having cash on hand for this sort of thing. So, like, the good part of me likes to hope that, you know, the big boys out there can have enough liquidity and capital for this to essentially do what it's got to do. But here's some facts. The liquidity that's gotten put in AMC stock is absurd. I mean, the market cap on AMC is as high as it's ever been easily right now. In fact, Matt, correct me if I'm wrong, but is it not higher than GameStop right now? I'm pretty sure that the market cap on AMC is higher than GameStop. I could check this on Webull really fast just to fact check this. So the market cap, 23.99 billion, and GameStop currently sitting at, let's find out.
17.
Out.
You're right.
Yeah, 17.58. So there's actually more overall dollars in AMC stock right now than when GameStop is right now, which is absurd. I mean, that's a lot of liquidity. And there's been some pretty major moves, but I think ultimately what happens if the DTCC or different brokerages decide to halt buying is we have to hold on to momentum, you know? So it's tough to anticipate what's going to happen with momentum. The charts tell you the story. So like coming kind of circling this all together, you know, this, will they halt buying? How will we know when shorts cover? The chart tells you the story, right? So you can realize how the market reacts to anything simply by looking at the price action. So like, for example, when AMC has sold shares into the market before, when they announce they're done, you'll see the stock price rocket. And some people might think that'd be bad news. Some people might think that's good news, but the market tells you the story. The chart is like a storybook that you're reading in real time. So if they were to halt buying in some sort of way, pay attention to the chart for a half hour. That's going to tell you exactly, you know, what it's going to do to the momentum and if people are really going to react to that in any sort of way. Like I said, I like to think that all these new NSCC, DTCC, SEC filings that have come out to essentially mitigate risk to these big hedge funds, to mitigate risk to the National Security Clearing Corporation, and to mitigate risk essentially to the retail investors, the apes, is going to do something good. I like to think it will.
Now, I want to ask you specifically. I made a deal to buy AMC and hold it for a year. Now I'm getting a lot of people who are like, "Oh, you know, big mistake. Don't hold it. Get out there and squeeze." I'm looking at it, going, "Look, I like buying and holding stuff, you know, and so I'm sticking with my deal of a year. But what am I gonna go through? What's gonna happen to me?"
It's gonna be a roller coaster.
It's gonna be a roller coaster.
It's definitely a roller coaster.
There's no other way to put it. I think. Go ahead, man. You go first.
Yeah, I think with that's a lot of the times two different arguments are getting conflated right now. Trey and I are both of the opinion that this is just terminology. I think there's day trading. I think there's long-term investing. So day trading 1 day, long-term investing, I would say at least over a year. And to me, anything in between, I just call it swing trading. And like, I guess people could argue trading, like, right. Yeah, like just something more of a shorter term thing, bigger than a day trade, shorter than a long-term investment. So with that, I think right now there's various characters who come on and say, okay, like long-term investing, AMC, I don't like it for reasons X, Y, and Z. And like, okay, that's, I think, a conversation to be had, but that's not even what we're talking about right now. Right now, we're talking more of a swing trade, a momentum trade. Let's see what goes on with these shorts and if we can get them out of their position. So I think right there, it's, yes, we're talking about the same company, but two different things. The way I would do it is right now, I'm very, very focused on this narrative of a short squeeze, of a gamma squeeze, of FOMO buying. And then after that narrative's over, that's a whole nother conversation then of like, do I like where AMC is going? Do I like the fact that they're going from 5 billion in the box office this year to hopefully 8 billion next year? And then beyond that, do we want to talk about the incredible slate of Marvel movies alone, of how Quiet Place 2 is doing super, super well in the box office? F9, like right now, I do understand how some people are talking about the rise of at-home streaming, But even this year alone, coming out of the Rona and everything like that, there are movies that there's no chance that I won't watch it for the first time in the movie theater. I think there's like a nostalgic, sentimental aspect that, like, even in 2019, when I still had Netflix, Hulu, all of them, I still had the AMC, like whatever their membership thing is, to go as much as I wanted. I just like doing it.
Nice. Trey, what do you think?
I think there's a fundamental long-term case for AMC, but it's not yet. This is a different chapter in the storybook, essentially. So what you're watching happen is momentum trading, swing trading, and you can't sustain something like that for a prolonged period of time. It's unrealistic to assume that AMC is going to run up 400% a month for the next 12 months. I mean, that'd be like some Tesla growth. Unless the squeeze is for a year. I mean, maybe it could, but I just think about volume exhaustion. How many people are buying right now? And is that sustainable for a long period of time? How much liquidity is getting put into the stock, right? So in this moment in time, you might, to be honest with you, Kevin, watch some really awesome gains show up in the portfolio, and then you might lose them for a while until the long-term thesis comes into play if you're not deciding to sell into the squeeze. And, ultimately, I respect, honestly, the fact that you're going to hold that for a year. Power to you, man. That's awesome that you're joining the cause. But I just don't think we're at that long-term case yet. I think you're in the short term. You're looking at a squeeze. You're looking at people who are trying to stick it to the man, trying to stick it to the hedge funds and show them, look, these dumb money guys, we're not as dumb as you think we are. In fact, we're making more money than the smart money guys. So that's where we're at right now.
Another thing is, I want to just briefly ask about this naked shorting again. If naked shorting is so common, then it seems like it would happen above and beyond shorting, because as you mentioned, a hedgie puts an order in, or an institution puts an order in to short. The broker's got to match this up, and if they don't, then it's naked. Somebody's basically shorted something that doesn't exist. But eventually, I'm sure they find these shares. And it would seem to me that naked shorting might be something that happens temporarily. And I want to hear your thoughts on this, where maybe naked shorting is this temporary imbalance of shorts. Okay. And then maybe the short interest is underrepresented by 2, 5, 10%, whatever. But, even if naked shorts were counted, where do we actually think they'd be? 30% in total with all the shorts? That's still pretty different from GameStop. So what do we think? Do we think this is like, no, it's way more? Or what do you both think? Let's start with you, Matt.
I guess with me, it's hard to put the number out there. Like, I guess with mine, I like to, live in the world of very tangible data. And that's the one thing about this missing equation is we don't know it, because like inherently it's just the fact that it's not reported. That's the issue. That's what we're arguing for, is like, we're all like kind of, I guess, in the darkness of what is the magnitude of this number. And for me, because of that, knowing that we're not going to get the specific one, like, of course I have my own like personal theories and stuff, but even if I didn't acknowledge that at all, the numbers that are reported, I still absolutely like it for the squeeze scenario that we're currently looking at. So like, I look at it as more of like a conservative floor thing, and I like that. So if anything, when we find out more of this information, because even if they are naked short, when it goes up, they're still going to be losing money and have to buy back in. So I view all that as just like a cherry on top scenario.
Gotcha. Okay, Trey?
Yeah, absolutely. So the exchange reported short interest is still significantly high. Anything above 10%, I would consider to be pretty massive. That's just one piece of the puzzle. So then you've got the failure to delivers. You've got these naked shorts that are going to the market. You've got liquidity getting put into call options and puts, both of which can, swing the stock price up and down either way. And then if you want any sort of argument for either algorithmic trading or naked shorts going into the market, I look back on January 27th. I use this as an example all the time because it doesn't make sense. There at the time about 150 million total shares free float on the market that were circulating, right? And assumably, most of those had to be held by either retail investors, short positions, institutions, insiders. And on that day, you saw 1.2 billion in volume. Now, to put that in perspective, typically Apple on any given day will see a couple 100 million in total volume on a day, but they've got billions of shares that circulate on the market. So for the entire free float to circulate 8 times over shows you that there's a magnitude of different spiderweb things that are playing into this whole equation, whether it be these failure to delivers or the algorithmic trading that are scalping penny by penny by penny, back and forth either way. We can't prove on any given day when that's happening, right? But just adding this all up together, you're looking at an equation that says X equals Z. but you're not getting that Y variable that makes Z make sense. And we just don't know what that Y variable is. So that's my argument for how we know, at least I know personally based on speculation, that things are happening the way they are.
Wow. Now, what do you say when other companies report high short interest? Like, for example, Clover's like 40%. You've got, I think, Workhorse is like 49.6%. At what point does the short interest matter? Does the short interest attract folks to just make a bet on it? But does it require a movement? Or what do you all see? I'll start with you, Matt, if you don't mind.
Yeah. So with that, and that's one thing I try to stress is there are many new people who just entered the market starting this year. And that's a tactic. It's like, oh, okay, I saw that this was a high short interest and like we want to just keep buying in those. But historically, when there is a high short interest, they actually go down. This is why this is such a unique black swan event, is because the reason the short interest is high is because many of these informed analysts on Wall Street notice a sizable weakness, so they're all taking bets. And then it ends up becoming a self-fulfilling prophecy because they're dogpiling onto it. That's why this whole story of GameStop and now AMC has become so interesting, because we're bucking the trend. There's enough of a community and an insane passion to like fight back against all of that negative selling pressure to push the stock the opposite way. So moving forward, to anyone listening, I would not recommend just seeing a high short interest and expecting it to explode. Please understand this is very much the definition of a black swan event. And I'm not saying there's not going to be more, but understand this is not normal of like how the stock market like normally reacts to high short interest.
Yeah. Trey?
So I would explain heavily shorted companies essentially as a sitting ball of kinetic energy on the top of a hill, right? So if you're looking at this heavily shorted stock, this company, and all that you're seeing at face value is that it's heavily shorted, you got to do a little more digging as to why it's shorted. Is it actually a weak company? Are their balance sheets okay? Do they have a long-term longevity in the market of a year, 5 years, 10 years, 15 years from now? If you can't check all those boxes, then there's probably a reason that it's heavily shorted and it might not be prone for a squeeze, on top of the fact that you need people to be interested in it, right? So if there's a heavily shorted stock, there needs to be some sort of catalyst or like a bulldozer that can push that boulder down the hill. Otherwise, it's just a ball of kinetic energy that will never come to fruition. It needs some sort of reason. And that's what's, beautiful about AMC and GameStop is both of these have potential, long-term longevity in the market, a year, 5 years, 10 years from now, depending on the way that, GameStop rebrands and AMC recovers and the box office movie, all these movies come out. There's a long-term case for both these companies. And then you have the catalyst, right, which is the boulder rolling down the hill, right? So heavily shorted companies in and of themselves will not trigger a squeeze. You might get sympathy plays, which is what happens with Express, Bed Bath & Beyond, Microvision, Koss, all these companies that will, I think, inevitably squeeze up a little bit when AMC runs and GameStop runs, but they're different. It's just a different thing. We can't compare apples to oranges, essentially.
Yeah. Now, what about, going forward with this transition? So you're going to look for when the shorts cover as an opportunity to make a transition. Are you expecting this? Like, what kind of price action are you expecting to signify this? I know short interest going down will be one of the variables, but what are the other variables? So short interest going down, maybe cost to borrow changing, and obviously I'm assuming some kind of price change. How much? Matt, let's start with you.
Yeah, so you can do some really crude garage math, like, for example, not referring to short shares, referring to just the shares on loan. So shares on loan and short shares, you loan them out and then you take the short. They're not the exact same thing, but obviously there's a very high correlation. There's not many people that want to loan something out and then not actually use it. So we live in a world of T2 settlement. So on Wednesday, AMC, I believe, ran 95, 96%. And at that point, there was 140 million shares on loan. We don't know the exact number of shorts just because of how things are reported. 2 days later, you can see some of the shares being returned from on loan. That was about 30 million. So right there, it's some unknown proportion of legitimate shorts versus just shares that were on loan that they're like, you know what? I don't want to mess around with this anymore. I'm just done with this play. These are just the short, shares on loan. So that means we still have about 110 million to go. So I'm talking about potential shorts, that's not accounting for any naked shorts. I'm not accounting all for any gamma squeezing. And gamma squeezing, just for those of you who don't know, it relates to the options market. When options go from out of the money to in the money, market makers, to protect themselves from what's referred to as delta exposure, that's buying. And then the third part of this equation that you'd have to be a master in crowd psychology to really understand would be FOMO buying. So right there, you have shorts continuing to cover. We don't know what's going on with naked shorts. You have a gamma squeeze in the market, and then like the dark horse X factor is FOMO buying. And because of that, you have a very complex multivariate equation. So like I have never seen good reasoning of how high the ceiling truly is, because I don't know how you would account for all four of those simultaneously.
Trey, what do you think?
I think it's doing injustice to $80, 100. I think it could do that. I'll say that right now. But I think it's doing injustice to put some sort of ceiling cap on this, because for me to come out and say this is exactly what I'm looking for, when truthfully I don't know how high this can go, is doing people dirty, because people, will be ultimately influenced by my decision to throw out some random number, when in reality, we can't account for FOMO buying. We can't account for how many call options are going to get purchased, run in the money, get hedged for, how many shorts are going to cover and when. But I'll tell you this, you can look at the chart and it's going to tell you a lot of the story. So I look for two things. I look for continuation of momentum. And currently as it sits right now, you've got a massive bull flag rocking on AMC, which is a bullish indicator. I like that. And I look for volume follow through. So I call it a closing bar of volume. So back in January, you don't know until afterwards, right? The day that it's going to have the highest amount of volume. But you saw that January 27th had that closing bar of volume. It had the most volume on any given day that you'd seen during that whole run-up squeeze period. And I'm going to be looking for that continuation of volume and a peak of new volume that we've seen on AMC stock trading, and follow through with that momentum, the volatility, because that's going to show that there's still interest in it. Barcoding or no price action is not bullish. That's, in fact, this shows a little bit of a loss in interest. So if you're not seeing that volatility and that sway and emotion showing on the charts, that to me is going to say, look, we probably come pretty close to capping out where this is going to go, but that's not here yet. It's just not. You can't squeeze without all the shorts covering. There's still call options that can run in the money. There's still interest in the stock. Naked short selling exists. This is a live cat, man.
So barcoding, just for the folks who are watching that might want clarity on that, you're essentially meaning you're consolidating to a flat and then just moving up and down within a very, very tight range across, and you're not going anywhere. You're boring is what I call it.
Yeah, exactly.
Exactly.
All
right.
Now, what I want to do for a moment is, if you don't mind, I'm going to pull up Ortex here. I know you both use this, and I just want to ask y'all. So what do you all like looking at? Because I'm looking here. We've got cost to borrow. It just has numbers here, right? So 10.36 7 days ago, 9.26. We've got utilization here, days to cover, shares on whatever. What do you all like to look at?
I mean, I could take this one, Trey. I'm a big fan of Ortex, of what we have going on. I think that there's really three major things you need to take into account, and then two like kind of bonus ones. So the top left, you have the short interest, the second one over. So that's the rough estimate of the amount of shares betting against the company divided by the shares in existence, and you get an interest. So very, very important. That's like the one a lot of people are citing, the short interest. Then if you go two over, you have the shares on loan. That's the one I follow a lot, just because we're getting that information from prime brokers, not hedge funds. Ortex is sourcing that data from about 85% of prime brokers in existence. So it's how many did you loan out today? And then if you go all the way to the right,
wait, is this in total, or how many did you say today?
No, that's how many are loaned out like at the moment in time. So it could go up.
Okay.
Yeah, it's not per day. It's a running cumulative number. And then all the way to the right is utilization. And that's another ratio of how many shares are on loan divided by how many are borrowed divided by total loanable at that moment in time. So think of it as like a pie. So right now, 99% of all AMC shares are borrowed that could go on loan. So like you're almost maxing it out. And as that number is sitting at 99 or 100, that's when you really start to see the cost to borrow shoot up. And the one thing, if you could come to the chart and then go to show advanced.
All right.
So 3 down, you have cost to borrows on the 3 week. If you could turn that off and do costs or days to cover, on the 2 week instead. So those top 3 ones are like my main 3 go-to. This one I think is a good bonus. So what days to cover it is, when I first learned about it, it was also referred to as the short interest ratio. And it's a theoretical number of if all the shorts wanted to cover at once in unison, how long would it take it for them to get out based on like your current average running volume. So right now we're about like half a day. And as you trade more and more volume, this number naturally goes down because you're dividing by some sort of like increased value. But if you could turn everything off, the one cool thing I want to show you there, if you just take everything off that chart, and then if you go about, bring your mouse up, the average 2 higher, right there. Oh, and then bring the chart back up, excuse me, just so we could see the AMC's chart price.
Right. Price, sure.
So if you give us the most recent reading on it, whatever the most recent date is, 50 days, as in the people betting against AMC, like there's a big assumption that the shorts are new. No, they have been on average loaning out AMC for 50 days. That's how long they've been doing this. That they're almost in this for 2 full months. They are clearly seriously underwater. There, of course, are new shorts. We see that coming across, but on average, they've been betting against AMC for 50 days. That's in the price range of potentially sub $10. They are very, very much hurting.
Yeah, you can almost go back here to, the beginning of, let's see if, would love to be able to go to 2-year here. But you could really see the shorting really accelerate here in the pandemic and how long they've had it. So that essentially what you're saying is this implication of lots of people took on shorts around the beginning of the crash here, March 2020. And you kind of see them holding it because the average length keeps going up until they maybe started not shorting as much when we had this run. What was this, around vaccine time? Yep, right around vaccine time, huh?
They got out. Yeah. So right there, that tells me 2 things. The fact that they're in for 50 days means that entire time they've been paying the cost to borrow fee. So, and not only, so they're losing money there, and then they're losing more money because the stock is clearly higher than it was 50 days ago. So for 2 reasons of like who's winning the current fight, I mean, it's the scoreboard. It's right in front of us. Obviously, they are hurting. There's maybe some lucky shorts who got in at 70 and right now they think they're looking pretty good, but let's see how this next week plays out. I have a feeling that there's going to be even more blood in the water.
Trey, what do you look for on Ortex, or pretty similar?
So when I'm live streaming, Kevin, and watching just kind of the live price action, I like to pay attention to that live updates tab that's right below your mouse right there. And that'll show you when short interest is changing, from an intraday perspective. Gives you an idea of how many return shares there are, how many borrowed shares there are, and then the net difference. And then the really cool feature that I like to see is that cost to borrow average, and they've got a minimum and a maximum. Now, these are for new shares that are taken out on loan. It shows you the lowest price they're paying for an annualized interest rate as well as the highest. And I think it would have been about a month or a month and a half ago, Matt, when I saw a maximum of like 250%, which is absurd. I mean, I don't know if they're still paying that or not, but it gives you an idea of how hard to borrow the stock is at any given moment in time. So like when that utilization is really close to being maxed out, meaning that all available shares for lending are nearly out on loan. You've got a large amount of shares on loan. There's not a lot of shorts available to send into the market, meaning you probably got some naked short selling that's happening, more algorithmic trading. It reflects on that cost to borrow. So the higher that cost to borrow is, the more likely I'm inclined to believe that you're seeing more of those malpractices that we've kind of talked about throughout this interview.
So an indication that you might be looking for when the shorts are covering is when this actually goes back to a normal lower level, huh?
I'd say, yeah, for sure. So that, like we've been talking about, that cost to borrow signifies the difficulty of getting stock and coming out profitable on that stock. So if most shorts are getting out of their positions, that would mean that there's more shorts available to borrow, more shares available for loan. That cost to borrow will go down significantly, back down to that 2%, 1%, maybe less than 1% range. But it's still pretty dang high. I mean, I wouldn't want to pay an 8%, yearly interest rate on my mortgage if I had to do that. That doesn't sound like cash money to me.
Yeah. So I'm gonna just for comparison jump on over to something like Apple, for example, and I mean take a look at that cost to borrow here, annualized max of 2.37 versus that 35% there, and a low of basically nothing, free. That's incredible. Wow. Yeah, that is very interesting. And then so you do have some shorts over here that Let's see. Where's that average day holding? You like that? I think you said that was under the advanced tab.
Yep, show advance, and then it's like average day, about a third of the way down.
Days. Oh yeah. Okay, there it is. On loan, average day. Gotcha. So here you've got people also kind of shorting Apple here, but lately we've gotten a lot of shorting in the last like 90 days of tech. So that's interesting. So let's turn off some of these other things here.
But even with that, like the magnitude of it, Apple's short interest isn't even 1% right now.
Yeah.
So like it's going up, but it's going up from like a grain of salt to 2 grains of salt.
I love it. And and so you're really looking over here where you're seeing, hey, look, we've got less than 1% shorted here. Now, Trey, you had mentioned that Tesla was actually relatively, or I think Matt, maybe it was you. One of you mentioned.
I think that was Matt. Matt, but yeah.
I mean, so tell me about that. Why would this be highly shorted if it's 5%? Is it just because it's so large of a company?
No, it's just more of like in the stock market, by the time you get to that 5-10%, it's just you don't normally see numbers like that, especially in established companies.
I see.
So okay. Just in pure magnitude, not really taking the amount of shares into account. It's just like shorting is not, it's a practice, but it's way more common just to buy a company you like and you run with that.
Gotcha. Okay, so now I want to know what's the next company, or is how do we determine the next company? Like how would somebody know? Is it just like subscribe and wait for the video? Where are you hunting for that?
It's funny because me and Matt were actually having a phone call about this before we got onto this live stream, like what the direction of the market's going to be for retail investors. And we, at least I'll speak for myself. I'll let you speak for yourself, Matt. My apologies. But I personally believe that you've got this new breed of people out there, the apes, that are essentially looking for a new non-traditional style of investing. And myself, personally, I've got a handful of companies that I love a lot. Like Microvision was my first ever company that I started digging into on YouTube. It was the one that I thought had a great future, and they're starting to prove themselves slowly here over the last couple of months. In fact, I think since January, when I first came on here, they were trading at like $5 or $6, maybe $10, and now they've seen 30, which is incredible. But I think you're going to see people start to look at other companies who are maybe not shorted for good reasons, who have a good fundamental long-term growth in the stock market, who have, a space in the market spot, 5 years down the road, and people start focusing on those. Like, who knows? Maybe Microvision could be that next stock. Maybe there'll be some other stock XYZ that we don't even know about right now that people want to go on with. But I'll tell you this right now, I think it would be sort of a waste of what I view to be my strengths as a person to go into some sort of traditional style investing where I'm just focused on fundamentals and this and that, because I feel like, there's something really cool happening right now over the last 6 months where you created this pressure on short positions, which created pressure on the entities that govern the stock market, like the NSCC, DTCC, SEC. I cannot believe for a second these new filings would have come out if it weren't for the last 6 months of happenings. And I like to think that there's more good things that can be done by focusing on more of these, heavily shorted companies who maybe shouldn't be in the position that they're in right now. So I'm going to be looking for that next one. I'm going to be looking for that next company that I think people are going to love. I think people are going to, want to fight for and actually just like the stock. Simple as that.
Well, now I got to ask though. I mean, some would say that GameStop and AMC and even like a Workhorse when they lost their contract or other companies, some would say that it made sense to short companies that did get beat up in the pandemic. What's the difference between it makes sense to short a business that has headwinds? What's the difference? Like, at what point do we say no? It's overly shorted, right?
Right. So this is where it comes into play for me to essentially look at a company that you think will go bankrupt and short them because you think they'll go bankrupt is one thing. To look at a company that might go bankrupt and to try to bankrupt them is an entirely different thing. Those are way different scenarios here. And I think that's what happened with GameStop and AMC both, because not only do you have these heavily shorted stocks, naked short selling, failure to delivers, all these sort of things that are confirming that there's some malicious intent here, but you've got, essentially financial media who's playing on the side of these same suits who are trying to bankrupt companies. If companies go bankrupt, they don't pay taxes on the gains that, happened. I mean, they want these guys to go for broke, even if it means retail investors lose money, even if it means that people who work for the company, the retail workers, lose their jobs. I mean, it's honestly really sad. And that's what I feel a lot of pride in is how much the community has come together around that thesis. So.
Oh, that's so honorable. I mean, that's freaking awesome. Okay, final thoughts from both of you. I want to know what's next in sort of in general. I mean, I know it's holding on to AMC, but I want to know broadly for you. Are you all in on AMC? Is AMC a part of your portfolio? And how does your portfolio look going forward? Are you going heavy on just the momentum plays? Are you buy and holding? Are you worried about hyperinflation? So I want to start with you, Matt. You know, broad overview, broad future, zooming out at AMC here, percentages and the future.
Yeah, so kind of during the lull from late January until now, there was a portion of like I currently have AMC and GME both shares and call options on both companies. But because of how much AMC has really run, it's dominated on a percentage basis of my overall portfolio.
Yep.
I think as of market close, it was roughly about 300,000 involved with AMC for me, or maybe like 275 and then 25 on GameStop. So I'm very heavily invested for that. Like those are just serious numbers for me on a personal basis. Moving forward, when I get to our definition of victorious, when I see that the shorts have covered and I like hopefully lock in considerable gains on a bigger basis, I've been slowly but surely learning more about crypto, and then considering all the unlimited quantitative easing going on in the US, I do have personal concerns about the dollar and where we're going with that. So to me, it does seem as like a potentially good store of value to move over, at least to be some in crypto. Right now I have a bit of crypto, but even with that, I mean, I've been trading for the better part of the decade. Like I'm not just going to stop in the stock market, the options market. It's a passion of mine. And now it's gotten to this level where I can share that passion with so many people. So for me, I'm hoping to take a lot of the AMC GME games, put it into crypto, but I'm not going anywhere.
Wow.
Stocks, it's on to the next one, and we'll find out what that is, hopefully sooner rather than later.
Wow, that's incredible. And any particular crypto, like which cryptos? And I just want to make a note because one person has commented on this. Well, one of the reasons I'm starting with Matt disproportionately here when I ask the question is just to give Trey's connection a tiny little bit more time. That's it. Okay, no favoritism. I like both of you equally. Okay, just want to make it clear. So okay, I want to know which cryptos and then Trey. Okay.
Yeah. So. And maybe this is something I can learn from you about it. Like I have some Bitcoin because I look at that as a store of value. I'm actually involved a little bit in Doge because I view that to be a bit more of a digital currency. And then like certain ones in more of the world of utility. I have some Ethereum. I'm excited for Ethereum 2.0. I have some Cardano. I really like what's going on with that. And then the one I've really been learning about recently, and I'm trying to learn more to feel more comfortable with it. Solano is I'm getting a lot of buzz for that and its potential like utility case coming up in the next couple of weeks, months. So I don't have a particular favorite. I'm just trying to build out like a properly risk reward managed crypto portfolio.
Trey.
So my current position in AMC, you know, I was very fortunate to make some good money on call options, and as it sits right now, I've got about just shy of 8,000 shares of AMC stock, and then I've got about $150,000 of call options. So total position coming out to just over $500,000 as it is right now in AMC. With that being said, once the AMC storybook is written, I try to preach this a lot because it's very important. You can play a high risk, high reward portfolio setup when you're not playing with a lot of capital because, you know, 10% gains on $1,000 is $100, but 10% gains on $1 million is $100,000, right? So once you have some capital, I think it's really important to manage that wealth and not risk the majority of your gains, right? Not looking for that next essentially home run. So my game plan is to manage wealth, you know, moving forward in the stock market with some being in long-term stocks. I think the way that I allocate it is about, you know, 80% in long-term positions, and then allocating about 10% for swing trades, about 5% for maybe some day trading, and about 5% for options. So keeping the gains that I've had in my high conviction stocks that I think are going to do great things, and then having that free capital to look for those next big possible home runs. Then if I'm wrong, you're not risking the farm. You're keeping the wealth that you've already made for yourself. So that's kind of my game plan with my own portfolio.
What are your high convictions?
So I've said this before. I'll say it again. I remember back in January when I brought this on to the channel, Microvision. I really believe that automotive LiDAR is going to do some great things down the road. You know, Tesla is a beautiful car. In fact, I'd like to own one here someday. but there are improvements to be made. I think they can do good things, with some LiDAR. And if not them, there's a bunch of space for this in the autonomous vehicle space, across the world. This is just going to keep getting bigger and bigger and bigger as things go on. I'm really excited about Ford's electric vehicle, but whoever they end up getting bought out by, which I think will inevitably happen, is going to improve the company long term. So that's probably my highest conviction stock outside of AMC.
I mean, honestly, I have to say, I made a video on this. Gosh, it's been a long time ago. But one of the things I mentioned was the cool thing about Microvision is they can put their LiDAR in essentially like the rear view mirror, and you have the forward facing LiDAR, which if you think about it, why do you need LiDAR to know what's up your butt, basically, right? Like, just look in front of you, right? It's so important. Like, pay attention to the front. And so that forward facing LiDAR that Microvision does, it's brilliant. And personally, I would not be shocked and I don't think it's a high likelihood with Tesla, but I wouldn't be shocked if one day Tesla's like, you know what? We'll just buy Microvision and retrofit it into every Tesla. You know what I mean? Like, I don't know. Right. It's just, I could totally see it happening. If it's not Tesla, it'll be somebody else, but I like that. I think that's a really a strong argument there. Okay. Wow. This has been incredible. Any last thoughts that you have, since I did specifically ask you something here on the last question? I just want to open it up. So I want each of you just to shout out your channel, and then any other concerns you have, or anything else you want to just say. I don't care. Go for it. As usual, Matt, and then Trey.
Yeah. I'm Matt Kohrs. If this is your first time hearing of me, you can find me on all the socials. It's just Matt Kohrs. Kohrs is Kohrs. YouTube, Twitter, all that good stuff. And for all the apes tuning in from the Ape Nation specific to what's going on with AMC, remember, we're just diamond handing it. Right now, when in doubt, zoom out. The battle is clearly in our favor, and I'll see you on the moon.
Well, there you go.
There it is. I love that. I love that. That's gold. So my channel, if you want to get a hold of me, is Trey's Trades. I'm on YouTube. My Twitter, there was somebody out there trying to sell me my actual handle, so I actually got Trades Trey. So I don't have it matching up, unfortunately. I'm on Instagram as well. It's Trey_Collins_001. Somebody also tried selling me my handle on Instagram, so out of luck there. But nonetheless, those are the places you can find me. The last kind of message I'd like to pass along is any good journey has conflict, right? So in the stock market, you're not going to just rip up. That's as simple as it gets. You've got the rips, you've got the dips down in the freaking shadow realm, as I like to reference Yu-Gi-Oh here. It's a journey, right? And you can't get emotional about profits that are not yet realized. So hodl on. If you don't feel comfortable selling at the price it's at, just wait until it happens. Wait until new information comes. You can make a better decision. Whatever it is, we're going to be okay, right? Just keep weathering on, celebrate the wins and weather the losses.
Wow, that was incredible. I love the dips and rips. That's great. Well, golly, thank you so very much for being here. Pleasure, as always. Stand by for a moment, if you don't mind. For everybody else watching, if you found this helpful, share the video, consider subscribing, and folks, we'll see you in the next one.